Welcome back to Being Financially. That, powered by AI, adapting in real time, and leaving traditional funds in the dust. But is this the future of smart investing? Or another hype bubble? Let's break it down. Imagine an investment that can analyze and adapt to market changes in real time without human intervention. That's what the new AI-powered ETFs claim to do. Using advanced algorithms and machine learning, these funds aim to outperform traditional ETFs by constantly adjusting their holdings based on market conditions. But is this really the future of smart investing, or is it just another passing trend? Some experts argue that the rise of AI-powered ETFs could lead to a new era of intelligent investing, where algorithms can identify investment opportunities and mitigate risks more effectively than human fund managers. This could potentially result in higher returns for investors. On the other hand, critics raise concerns about the potential risks of relying too much on AI in investing. They argue that the use of complex algorithms could lead to unforeseen market disruptions and increased volatility. There is also the question of accountability. Who is responsible if an AI-powered ETF makes a costly mistake? Despite the debate, one thing is for sure: AI-powered ETFs are shaking up the investment landscape. Investors are increasingly drawn to the potential of higher returns and lower fees that these funds promise. And with advancements in technology, AI-powered ETFs are becoming more sophisticated and refined, attracting even more attention from both individual and institutional investors. So, is this the future of smart investing, or just another hype bubble? It's hard to predict for certain. While AI-powered ETFs have the potential to revolutionize investing, it's important to approach them with caution and skepticism. As with any investment, thorough research and understanding of the risks involved are crucial. In the end, whether AI-powered ETFs will stand the test of time remains to be seen. What is certain is that they are redefining the way we think about investing and sparking important conversations about the role of technology in financial decision-making. As the investment landscape continues to evolve, it's clear that the intersection of AI and investing will be a topic of great interest and debate for years to come. Are you familiar with ETFs, but wondering what AI-driven ETFs are all about? Well, let's break it down simply for you. First, let's quickly refresh our memory on what ETFs are. ETFs, or exchange-traded funds, are a type of investment fund that are traded on stock exchanges, just like individual stocks. They typically hold a collection of assets, such as stocks, bonds, or commodities, and aim to track the performance of a specific index. Now let's introduce AI ETFs. These are portfolios that are managed using cutting-edge technology like machine learning and real-time data analysis. This means that instead of being actively managed by humans, the investment decisions are driven by artificial intelligence algorithms. The AI is constantly analyzing market trends, economic data, and other factors to make decisions on which assets to buy, sell, or hold. Some examples of AI ETFs include QRAFT AI ETFs and AIEQ, AI-powered equity ETF. These funds are designed to harness the power of AI to potentially outperform traditional ETFs that are managed by human fund managers. Now let's overlay some ideas to help you visualize the difference between traditional ETFs and AI-driven ETFs. We can include a chart animation comparing the performance of ETFs versus AI ETFs, showing how AI-driven portfolios may offer more potential for growth and better risk management. We can also provide a visual of a neural network picking stocks, illustrating how AI algorithms are used to analyze and select assets for the ETF based on complex patterns and data. In conclusion, AI-driven ETFs represent the next frontier in investment management, leveraging the power of artificial intelligence to potentially deliver superior performance. For investors, with their ability to process vast amounts of data and adapt to changing market conditions, AI ETFs offer a compelling alternative for those looking to enhance their investment strategies. Have you ever wondered how automated investment strategies actually work behind the scenes? Let's take a closer look at the inner workings of these advanced systems. First up is data ingestion. Automated systems continuously gather and process massive amounts of data, including news, earnings reports, sentiment analysis, and market trends. This constant influx of information allows the system to stay up to date with the latest developments in the market. Next comes the AI modeling and decision-making process. Through advanced technologies like natural language processing, NLP, and pattern recognition, the system can analyze and interpret the data to make informed investment decisions. These algorithms are designed to spot patterns and trends that may not be immediately obvious to human investors. Daily or weekly rebalancing based on predictions is another key component of these automated strategies. By using predictive analytics, the system can adjust the portfolio to optimize returns based on the forecasted market conditions. This proactive approach helps to minimize risk and maximize potential gains. So how do these automated systems compare with human-managed ETFs? While human investors can bring intuition and experience to the table, automated systems offer speed, efficiency, and the ability to process vast amounts of data in real time. This can result in more agile decision-making and potentially higher returns for investors. In conclusion, the inner workings of automated investment strategies involve sophisticated data ingestion, AI modeling, and decision-making, as well as daily or weekly rebalancing based on predictions. By leveraging these advanced technologies, investors can benefit from a more efficient and data-driven approach to managing their portfolios. Are they beating the market? Let's dive into the performance and case studies of AI-driven ETFs such as AIEQ and QRAFT. These ETFs utilize artificial intelligence algorithms to make investment decisions, aiming to outperform traditional market indexes like the S&P 500. When it comes to real performance data, these AI ETFs have shown promising results. AIEQ, for example, has consistently outperformed the market over the past few years. Similarly, QRAFT has also shown strong performance, beating the market in various market conditions. One of the key advantages of AI-driven ETFs is their ability to react faster to market changes compared to traditional actively managed funds. This can lead to quicker adjustments to market trends and potentially higher returns for investors. However, this faster reaction time also comes with risks such as overfitting the algorithms to historical data, which can result in poor performance in the future. Another factor to consider is volatility and expense ratio. AI-driven ETFs tend to have higher volatility due to their active trading strategies, which may not be suitable for all investors. Additionally, these ETFs typically have higher expense ratios compared to passive ETFs like SPY, which could eat into potential returns. To visually compare the performance of AI ETFs versus a passive ETF like SPY, a backtest chart over 3-5 years can be created. This chart would showcase how the AI ETFs have performed relative to the S&P 500 index, providing a clear comparison of their performance over time. In conclusion, AI-driven ETFs like AIEQ and QRAFT have shown promising performance results, but investors should carefully consider the pros and cons before investing. While these ETFs offer potential for higher returns through faster reaction times, they also come with risks such as overfitting and higher volatility. Conducting thorough research and comparing performance data is crucial in making informed investment decisions in the dynamic world of AI-driven investing. Are you a tech-savvy investor looking to dive into the world of innovation? AI ETFs may be the perfect opportunity for you to explore. These exchange-traded funds are designed to provide exposure to companies working on cutting-edge artificial intelligence technologies, offering potential for high growth and returns. However, it's important to note that investing in AI ETFs requires a certain level of risk tolerance and a longer time horizon. As with any investment in emerging technologies, there is inherent volatility and uncertainty that may not be suitable for ultra-conservative or long-term index-only investors. Let's take a closer look at two investor personas to illustrate who AI ETFs are good for and who should avoid them. First, we have the young tech investor, someone who is knowledgeable about the latest trends in technology and eager to invest in the future. This individual has a higher risk tolerance and a longer time horizon, making them an ideal candidate for AI ETFs. They understand the potential for growth in this sector and are willing to withstand any short-term fluctuations in the market. On the other hand, we have the traditional retiree, someone who prioritizes stability and security in their investment portfolio. This investor may not be comfortable with the level of risk associated with AI ETFs, as they prefer a more conservative approach to wealth management. For them, sticking to index funds or other safer investment options may be more suitable. In conclusion, AI ETFs can be a great option for tech-savvy investors seeking innovation and growth opportunities. However, it's important to consider your risk tolerance and time horizon before jumping into this exciting but volatile sector. If you're willing to take on the risks and stay invested for the long term, AI ETFs may be a beneficial addition to your portfolio. But if you prefer a more cautious approach to investing, it may be best to steer clear of these high-growth, high-risk opportunities. Are you interested in investing in AI ETFs, but not sure where to start? In this step-by-step guide, we will walk you through the process of investing in popular AI ETFs, including ticker symbols and platforms to buy on. We will also cover what to watch for when investing in AI ETFs, such as fees, performance history, and AI transparency. First, let's take a look at some popular AI ETFs and their ticker symbols. One popular choice is the ARK Autonomous Technology Robotics ETF, ticker symbol RKQ. This ETF focuses on companies involved in autonomous technology, robotics, and automation. Another option is the Global X Robotics Artificial Intelligence ETF, ticker symbol BOTS, which invests in companies involved in the development and adoption of robotics and artificial intelligence. Now, let's talk about where you can buy these AI ETFs. Many popular trading platforms, such as TD Ameritrade, Charles Schwab, and Robinhood, offer the ability to invest in ETFs. It's important to do your research and choose a platform that aligns with your investment goals and has a user-friendly interface. When investing in AI ETFs, there are several important factors to consider. First, you'll want to watch for fees associated with the ETF. This includes management fees and other expenses, which can eat into your overall returns. It's important to compare the fees of different AI ETFs to ensure you are getting the best value for your investment. Next, you'll want to look at the performance history of the AI ETF. This includes examining the ETF's returns over the past few years and comparing it to its benchmark index. It's important to note that past performance is not indicative of future results, but it can give you an idea of how the ETF has performed in different market conditions. Finally, you'll want to consider the transparency of the AI ETF. This includes understanding the underlying holdings of the ETF and how it aligns with your investment goals. It's important to research the companies held within the ETF and ensure they align with your values and beliefs. In conclusion, investing in AI ETFs can be a great way to gain exposure to the growing field of artificial intelligence and robotics. By paying attention to factors such as fees, performance history, and AI transparency, you can make informed investment decisions that align with your financial goals. So do your research, choose the right platform, and start investing in AI ETFs today. AI is taking the finance world by storm, with algorithms and machine learning now able to analyze market data and pick stocks with unprecedented speed and accuracy. But the real question is, are you ready to trust an AI to manage your hard-earned money? These ETFs could be the start of a new era in investing, where artificial intelligence plays a pivotal role in decision-making. But just like any innovation, it's crucial to remember that knowledge is power. While AI can process vast amounts of data and identify potential investment opportunities, it's essential for investors to understand how these ETFs work and the risks associated with them. On one hand, trusting an AI to manage your money could mean tapping into a level of expertise and analysis that is beyond human capabilities. It could potentially lead to better investment decisions and higher returns. On the other hand, it's important to consider the potential limitations of AI, such as biases in the data it processes or the inability to react to unforeseen market events. Ultimately, the decision to let AI pick your stocks comes down to individual comfort, levels, and risk tolerance. Some investors may embrace the idea of AI-driven ETFs as the next step in the evolution of investing, while others may prefer a more hands-on approach. So, what's your take? Would you trust an AI to manage your money? Drop a comment and let us know your thoughts. If this topic opened your eyes to the potential of AI in investing, smash like, and make sure to hit subscribe for more deep dives into the future of finance. After all, knowledge is power, especially when it comes to the rapidly evolving landscape of investing with AI.